as Tyler mentioned, you've been a longtime bull and you've been riding this pain trade higher well. So congratulations on the call, Tom. But based on what the Fed said yesterday, which is a possibility of 2 more hikes, 3 members of the committee saying possibly 6% is where they see rates could be headed. Does your view change, moderate at all?
Well, I mean, I think investors have to be cognizant of one thing, which is the Fed doesn't have a crystal ball into the future. So what we're seeing is the Fed's preferred roadmap, including those who want to get to 6%, in the face of what they see as existing inflation. I think over the past few months, I think what investors are realizing is many Fed members are looking at CPI and Taylor rule models and arguing that we need to be much tighter. But when you look at forward-looking measures of inflation, those are going to come down sharply. And I think investors are concluding that's going to change the mind of the Fed. So I think there are 2 hikes. It's definitely hurting the cats in the room. But I think one of the things I would just note is that the Fed can change its path. And I think that's why I almost think the Fed gave a green light for stocks to rally into the end of the year.
It almost sounds like you think that the Fed might not go through, that this was a lot of jawboning. I mean, if you're saying that the Fed can change its path and you think that inflation's going to come down much sooner, it sounds like maybe you think that they're not going to actually end up going through with 2 more hikes.
Well, I mean, Melissa, yeah, there's a lot of reasons I think this. I mean, one, in November 2022, I don't know if you guys remember when someone had asked the Fed during the press conference about the stock market rallying, Powell visibly flinched and became uncomfortable, and then the tone of that meeting turned immediately hawkish. In yesterday's press conference, there was no attempt by Powell to try to talk about tightening financial conditions, or he's uncomfortable that FANG's up 60% this year. And I think the reason being is I think the Fed understands that stocks and economic resilience is not really causing the inflationary pressures. In fact, as we know, wage pressures are diminishing, and there are still some supply side issues, which you mentioned. Those work its way through. So there's, I think, a growing realization at the Fed that inflation could be taken care of itself without only monetary policy response. And of course, we know there's been a tightening of financial conditions because of the bank stress. So I think it's a Fed that's turning more patient because they're at the level they're comfortable with. And I think too many think the Fed is trying to create a hard landing. And I think it's evident that they don't want a hard landing now.
Okay, so where do you see this? A couple months ago, or maybe a few weeks ago, you said 20% higher for the S&P 500. Does that stand at this point? And is it today's leadership that carries us to that point?
Yeah, our view is that we approach all-time highs again this year. I know it sounded preposterous when we said that in December, but the roadmap we see in the second half getting there is that FANG's done a lot of the heavy lifting. Believe it or not, compared to a year ago, FANG is up almost 60%. So to get to all-time highs, you just need the other 493 stocks to show some semblance of multiple expansion. That group is trading at 15 times. So we think there's going to be a pretty dramatic expansion of market breadth in the second half of this year, and that's going to help get us another 400 points in the S&P to 4,800.
Do you think that this is the kind of spending cycle where it will happen no matter what? I mean, maybe to varying degrees, but this is sort of in good times and in bad times sort of investment thesis.
Yeah, I mean, right now there probably is a little bit of FOMO at companies because they're worried about an arms race that's developing among their competitors if others are investing in AI. But eventually that is a zero-sum game in the sense that unless AI grows the end market for a business, it has to only be justified by saving cost. So I think you're in that phase where it's 1 + 1 = 3 spending, but eventually it has to be subtractive to spending, otherwise it's not going to create value.
Subtractive to spending meaning that companies will opt to spend on this, and there are going to be other areas where there are cuts. So there are going to be winners and losers, and the losers may be not necessarily the ones that don't gain the share in the AI race, but other categories entirely where corporations are just not going to spend.
That's exactly right. It's I mean, to me, it's no different than how wireless supplanted the wireline industry, how gaming essentially ate a lot of the economics of the media business. I think AI is going to replace some industries and some job categories, but parts of AI will also generate more revenues. It's just, that's going to be harder to actually invest in today.